Good day, everyone. Thank you for joining us here at S&B Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over the performance of our Community Bank benchmark group. Now, if you recall, this is the group that we utilize in all of our analytical reports that we put out to our clients. So when we look at this group, notice that the asset size ranges between 100 million and 5 billion. So we have a fairly large grouping of institutions that fall into that asset range. Overall performance for this group for the first quarter, we can see came down a little bit to an ROA of 1.11, down just 1 basis point from where it was in the fourth quarter of 2018 at 1.12. But more significantly is where we see the decline from where it was in the third quarter of 2018 when it was up to 1.20. So we saw a pull off overall in this benchmark group. Now we segment this group for our clients into 3 subgroups, just identifying their overall business plans as well as their tax effectiveness, and we can see that these 3 different subgroups include the sub-S banks that are filing under subchapter S, the stock institutions, and then mutual. And you can see overall similar trends in the ROA, but when we look at the overall levels of the ROA, there's a fairly significant difference. We see the sub-S group in the first quarter retaining an ROA of 1.41. And recall the subchapter S, they do not have to pay federal taxes, so that's why they always have this higher level of return. And then we have the stock groups coming in at 1.05, and those mutual institutions of a different operating plan, and they're coming in at 0.61. Notice overall, every group here declines between the third quarter to the first quarter of 2019. So we see this continual decline in the overall return on average assets. And when we look at the net interest margin, we can see a fairly significant 10 basis point decline between the fourth quarter of 2018 and the first quarter of 2019, going from a 388 down to a 378. So we had an overall decline. In fact, when you look back, that's only 2 basis points higher than where we were back in the first quarter of 2018. This primarily is due to the leveling off of the earning assets. Here, the yielding earning assets dropping 1 basis point from 462 to 461, but then also this continual creep up of that cost of funds, gaining 6 basis points from 0.84 to 0.9. Now this cost of funds, we have that cost of borrowings in there, that wholesale borrowings that pushes that up, but also, and more importantly, the cost of interest-bearing deposits. And we've seen this continual increase in this overall cost of interest-bearing deposits up to 1.06 as of the first quarter of 2019. So we see this continual increase, and I believe over the next several quarters, we're going to continue to see this increase in the cost of interest-bearing deposits for a number of reasons. One, just overall competition, banks reaching for deposits out there, having to put up those higher interest rates, but also just the nature of the deposits are changing. And we can see that when we look at the trend in the cash type deposits, the total deposit ratio, how it's been coming down. If you recall, this cash type deposits are those now savings, money markets, and DDA accounts. So we look at the overall trends coming down. This would suggest that customers' appetite now is pushing out more to CDs, and those CDs most likely are at premium rates because they're attracting these deposits. So when we start to see this, we can anticipate over the next several quarters this to continue and the overall cost of interest-bearing deposits to increase. So that's going to have that downward pressure on that net interest margin throughout 2019. Overall efficiency, when we look at the net overhead figure, we can see the net overhead figure drop from a 216 down to a 215, just 1 basis point. We'd anticipate this number to come down again. Typically, the fourth quarter is a little higher than average, and then we start to see this tick down over the course of the year. So this is coming down. If you recall, the net overhead is the difference between non-interest expense and non-interest income. We can see the movements quarter over quarter, a fairly significant decline in the overall non-interest expense, which is expected. But look what happened to non-interest income. That came down 4 basis points quarter over quarter, 6 basis points when we were looking back to the third quarter of 2018. This is where community banks are going to have to catch up in the ground here and make up some of that margin loss in the revenue, is finding different avenues for either being more efficient and reducing down that overall non-interest expense to assets ratio, or coming up with different means of generating fee income through different services, or making sure that your fees that you have in place are at market rates and that they're not being waived too often. So that's just a little analysis you might want to do as you move through the second quarter. When we're looking at the tax burden here, we can see overall average around that 21% rate, and we would say that if we were to look at an institution and they were very tax efficient, we would put them at around 16% in their effective tax rate. So 16 or below is what banks can identify as an effective tax rate. And that takes some time to work up to, determining what type of investments you want to get into, and then also either tax credits or in the loan portfolio looking at those tax-free loans. So it takes some extra time. That's a longer process to play, but it is beneficial, because if you can drop your overall tax burden by 5 percentage points, that's a pretty significant impact to your overall net income. Well, that's what we have for you today. We hope you enjoyed it. We look to see you next week when we get back into the economy and look at where rates are and the projection of where they could be going over the next 12 months. Have a great day, everyone.